what are some lessons you guys have learned from building out this systematic macro model that the average discretionary macro trader could incorporate into their own process, even if they're not like, part of your guys' this whole thing? Like what are some things that they could do to really try to systemize and be more effective with their risk management?
I think a mistake a lot of macro investors make is they just look at the facts, and the facts don't always line up with what actually happens in the market. The market works based off of expectations, not what's currently happening today, but what's going to happen in 6 to 12 months from now. That's kind of the situation that a lot of people had during 2022, as Gamma mentioned, where it's like, okay, even as the Fed was hiking, okay, well, the market's not going to survive this. We're at 3% rates. Like everything's going to break. It's not going to work. And sure enough, nothing broke and they kept hiking. So what our model does that helps in terms of that is we come up with our macro theories based on what growth and inflation is doing. And so that's how we're able to kind of quantify the expectations, because also our growth and inflation isn't current growth and inflation. It's growth and inflation expectations as priced in by the market. And so we take that data, and then from there we extrapolate on it and figure out, okay, what are the pain points in the market right now? What are areas that we should be looking at that align with the current growth expectations that the market is presenting to us?
Yeah, I think that already did cover a good amount there, but the most important thing at the end, right, is getting the picture across your desk without having the again, when you hear a lot of people talk on the internet and they share their ideas, most of the time they're talking their book, right? They're talking their book based on what maybe they have, like, again, they're leveraged long bonds or they're leveraged long risk in on the dip. They're going to pitch you that, maybe the worst is behind us, or maybe like the worst is going to come depending on their position. And a lot of people let that cloud their judgment. And I think that what Artie said's pretty much exactly right, that like, look, if we're in risk off today, we're going to be bearish. If we're in risk on tomorrow, we're going to be bullish. And the stuff we said today might look stupid tomorrow, but like, that's just how it works. And the problem is a discretionary investor doesn't want to look wrong. They don't want to have to change the next day. Like, for example, we could go risk on in 2 weeks theoretically, or if everything lit up, we're in 2 weeks from now, we're in risk on. All the comments from today would be looking and seeming ridiculous, right? People are like, oh, you were just bearish 2 weeks ago. And yeah, trends shift, and then you start trending, and then like over time you end up, you do look right. But the problem is like people don't want to take the idea that like your thesis can change so quickly. And that's what I think discretionary investors have a hard time doing, is being able to pivot on a swivel and then not being caught up in whatever thesis they may have absorbed with the data that was coming in when they made that thesis. Because that thesis goes online, right? They established that thesis maybe in a bear market or in a massive equity sell-off, but when strength starts emerging, that thesis doesn't change and it's anchored. And then they're stuck in this. And that's why perma bears, every drastic drawdown in the market creates a new wave and group of perma bears. It's just how it works.